Hello friends, this is Vijay Bhambwani here. Welcome to my weekly market outlook video. You see, last week I left a slight question mark as to whether the up move in the markets could continue or not. That is what my thumbnail said. Can the upthrust continue? Now, the reason why I left it like an open ended question was because I was seeing some headwind, some resistance in the market coming in from A, the rising oil and gas prices, and B, the bond yields. You all know that I give a great amount of weightage to the bond markets, and the bond markets were telling me that everything was not exactly kosher. So, what remained in favor of the bulls was number one, we have a budget coming up. Number two, we have the largest IPO in Indian financial markets history, the LIC's IPO, which is likely to fulfill India's disinvestment target to a very large extent, and therefore it is expected that the markets would remain firm till the LIC's IPO's feel good factor announcement remains. So, what exactly can we expect next week? I'm going to guesstimate that in the minutes ahead. Let's plunge right in, and coming up on your screen is the weekly market roundup. We can see that the dollar fell, and as I've been telling you since years, a falling US dollar is a positive trigger for emerging markets, including India. Since it curtails our inflation, we welcome a weak dollar. Now, as a result of a weak dollar, bullion and energy rose on week basis. And oil and gas rising are a worrying factor because they trigger inflation across the board. This area needs to be watched very, very carefully, and because this is something that FIIs and institutional traders alike are going to be watching with a keen eye. The 10-year benchmark bond yields rose on week basis, which pressurized the bank nifty. The NSE market capitalization was still healthy with gains of 2.26% on a week basis. The MWPL, or the market wide position limits, rose along expected lines, which is routine till the third week of the derivative cycle. Now, I'm very clear that it will be very crucial to watch whether the MWPL rises to the 33 to 35 range ahead of the budget. Failing which, I would feel, or I would infer rather, that the bulls are sending out a signal of some hesitation at higher levels. If they are convinced, why wouldn't they buy? Now, coming up on your screen are the index and stock futures volumes chart. Do remember, these are cumulative futures of January, February, and March. And the volume chart shows that the volumes fell on a week basis where the indices are concerned, and the stock futures volumes rose, but just about rose. Now, this is falling short of what I would have been expecting as healthy participation during a bullish week. So, volumes falling are not exactly great. Watch these numbers daily because I post them on my social media accounts. Do connect with me for daily updates. My contact coordinates will come at the fag end of this video. The basis chart on your screen shows the Bank Nifty basis, which is the futures premium over spot, mildly higher on a week comparison, whereas the Nifty's basis is lower. This is because selling at higher levels coupled with time decay can be attributed for the basis remaining under pressure. Now I come to the bedrock of our in-house exclusive studies that I've shared with you so far, the impetus chart. I updated my viewers about this early warning signal via the impetus chart through our free WhatsApp broadcast on Thursday as well as Friday morning. that the impetus reading was flashing a sign of weakness. And it wasn't just a sign of weakness. I used the words red flag. Now that saved the day for many of my viewers from the feedback that I received on WhatsApp. Thank you for your feedback. I'm going to endeavor to basically give you a heads up every time the impetus chart needs updates. If you should basically feel like being added to the broadcast, do send me an email on the mail ID that you see on your screen right here. So now the reading of the impetus chart is at a 9-day low for the Bank Nifty and a 12-day low for the Nifty 50. Note that the price has risen, and the price is called amplitude, which is in sheer rupee basis, whereas the impetus, which is the statistical velocity, has been falling throughout. Now, this warns of possible fatigue within the bull camp. Though it is premature to write off a pre-budget rally right now, but I would ideally like to see prices rise along with the impetus if any up move is to sustain itself. Right now, there is a very small red flag out there. Now, I assure you, I will keep updating you via WhatsApp about this in-house exclusive study. Whenever there is a material change in its reading, do keep checking your WhatsApp inbox for updates. And I remind you, send me an email on the mail ID mentioned above to be included in this free feature from us. Now let's see what the footprint of the four types of traders have indicated to us about what they've done last week. Where FIIs are concerned, their index futures net long positions fell slightly to 55,391 lots, which was 57,238 lots last week. Where stock futures are concerned, they have come off sharply to 1,17,215 lots net long, which in the prior week was 1,55,251 lots. Where DIIs are concerned, they've raised their Nifty net short index net short positions to 55,109 lots, which was 51,338 lots in the prior week. Where the individual stock futures are concerned, their net short positions have fallen marginally to 16,24,487 lots, which was 16,47,037 lots in the prior week. Where prop traders are concerned, and these guys are super sharp traders, they are brokers with their own individual positions because they know who's buying and selling just how much. So they are second best to insider traders. Now, where the prop traders are concerned, they've reduced their index short positions to 99,221 lots, which in the prior week was 15,024 lots net short. Their individual stock futures long positions have come off sharply to 1,73,953 lots, which in the prior week was 1,94,651 lots. Let's now see what the retail segment is doing. They've basically reduced their index net long positions to 8,939 lots, which in the prior week was 9,124 lots. Now pay attention to the stock futures. The retail guys have raised their exposures of net long individual stock futures positions to 13,33,319 lots, which was in the prior week net long of 12,97,357 lots. So the retail remains the only segment that has been doing the heavy lifting. Friends, let's now come to the bond yields, which are now at their highest levels in 24 months. Now that is something all traders should pay a great deal of attention to. Now, this is a worry, especially for banking stocks and especially the bank nifty, because bond prices are likely to provide, and they are falling as of now, which is why the yields are rising. So, falling bond prices are likely to provide a mark to market loss on banks' bond portfolios. Secondly, it means inflationary pressures are building up and that bond markets are expecting coupon rate hikes in the near future. Now, easy and low cost funds are like mother's milk for a bull market. If cost of funds, which is interest rates, are expected to go higher, it could change the sentiments somewhat. Do keep a keen eye on bond yields in the coming week, and because this is likely to be a source of funds for other markets, and if the monetary costs are going up, like I said, sentiments could turn a little mushy. Now, you are at a disadvantage if you ignore the bond markets, especially if you are a banking stocks trader or a bank nifty trader. So, please do keep a keen eye out on the bond yields. Friends, let's now go to the US dollar index, the benchmark index of the US currency versus the global basket of currencies. Let no one convince you that the currency market, just like the bond market, is not important for equities. Don't fall into this trap. You will be ignoring a very critical aspect of a market trend determination at your own peril. So, the US dollar index, as you can see on your screen, fell on 3 out of 5 trading sessions, and the falls were more pronounced than the rallies. Note how the price has bounced off a bullish trend line, which is 7 months old. That adds to the validity of the trend line. The price is below its 25-day exponential moving average, which is a month-long average holding on cost of an average buyer. That means buyers are now at a temporary disadvantage, which is actually positive for emerging markets, including India, because it cuts down our imported inflation. The falling dollar was one big reason for our markets to have rallied last week. So you must keep an eye on this metric. Let's switch to the weekly chart where we see a big bearish candle that took support at both the bullish trend line, which we saw on the daily, as also the 25-week exponential moving average, which is representing a 6-month holding on cost of a bull. So for now, the bulls have managed to defend the medium-term outlook. Will it hold? Time will tell. Now, this index is under pressure since 4 weeks, and it impacts the price of bonds, commodities, and equities alike. Last week, I advocated a range between 96.70 on the upside and 94.75 on the downside, which was breached mildly because the low was at 94.61. That is a full 14 paise below my expected support. That shows that the range expanded onto the downside rather than the upside. And based on this, I would estimate in the coming week a range between 96.25 on the upside and 94.05 on the downside. Do watch this metric very carefully because you will see trend determination in all asset classes being determined by the US dollar, especially the price of crude oil and natural gas, which will be multiplier commodities. They'll impact our inflation metrics. So keep a keen eye on this index. Friends, let's now turn to the Nifty, Bank Nifty. And the Bank Nifty rose 1.67% after gaining on 3 out of 5 trading sessions last week. The last 2 sessions saw declines. Note that Doji on Wednesday, like a very small plus sign on your screen. It shows that the open and close prices were very close to each other, with the days range being very small. Now, this is indicating indecision. The fact that Thursday and Friday after the small doji were bearish days means that the intraday high of Wednesday at 38,851 will now be an immediate hurdle for the bulls to cross. Note the price is still above its 25-day exponential moving average, which indicates a month-long holding on cost of an average bull. That means that the short-term trend is still optimistic and the current decline is only a technical correction at best. But for now. The weekly chart shows a small-bodied bullish candle with a long upper shadow, which shows the bulls surrendered some ground that they had conquered in the first half of the week. Now, till the peak of last week at 38,851 is not overcome forcefully, that too with high volumes and open interest, I would say that the bulls are likely to remain cautious. The intraweek low, on the other hand, of 37,929 must be defended at all costs in case of decline. The price is above its 25-week exponential moving average, which indicates a 6-month holding on cost of an average bull, which means the medium-term outlook is also positive for now. In the week before last, this index was number 3 on the most volatile list, and that's precisely where it remained last week as well. Now, last week I advocated a range between 39,450 on the upside and 36,000 on the downside, which held perfectly well in spite of all that volatility last week. In the coming week, I expect an estimated range between 40,000 on the upside and 36,700 on the downside. Trade light because the bond yields and rising energy prices are likely to be a relatively bigger drag on the banking sector rather than the Nifty 50. Keep your stop losses in place as usual. Friends, I now go to the Nifty 50, which is the most liquid and low impact cost traded instrument on the NSE's derivatives segment. This index rose 2.49% on a week-on-week basis, outperformed the Bank Nifty, and it gained on 4 out of 5 trading sessions. Now, as you can see on your chart on your screen, the fall on Friday was fairly pronounced. The pattern made on Thursday was a dragonfly doji, which means the opening and closing levels were close to each other and both were at the almost at the top of the day's range. Now, conventional charting will tell you that it's a bullish pattern as per the textbooks, because the bears were trying to push prices lower but were unsuccessful towards the closing of the day. However, I still went out on Thursday morning, that too before the markets closed, during trading hours, to warn you via WhatsApp with our in-house exclusive impetus chart about not being aggressive on the buy side. Now, that view was proven correct by market activity on Friday at the open itself, which was gap down. Now, the price still remains above its 25-day exponential moving average, which is a month-long holding on cost of bulls. So technically, the price is still in a correction mode for now. The upcoming budget and LIC's IPO are strong bullish triggers, whereas oil prices are a negative. So expect some amount of pull and push in the days ahead. Friends, let's now go to a weekly chart which shows relatively better outlook compared to the Bank Nifty. The price is above its 25-week exponential moving average, which is approximately a 6-month long holding on cost of bulls. So the medium-term outlook is also positive for now. In the week before last, this index was at number 9 on the most volatile list, but it fell 2 notches to number 11 because the range of the Nifty was smaller and individual stock-specific volatility rose in relative comparison. So the Nifty slipped on the ranking. Last week, I advocated a range between 18,400 and 17,200, which held beautifully. Now, I had posted on my social media accounts that the 18,287 peak was possibly the high of the week, that too during market hours on Thursday, saying that the Nifty was unlikely to go up higher thanks to the impetus chart. That's the kind of belief that I have in that study, which I have programmed. Of course, there are other in-house studies as well, and I'm going to share those with you in the coming videos over the coming few quarters. This week, I advocate an estimated range between 18,825 on the upside and 17,650 on the downside. Continue to trade light and don't forget your stop losses. The Jensen's measure that I used to mention quite often in my past videos, which is something that all hedge fund managers swear by as a reliable metric of risk and reward, is not really very conducive to aggressive, fresh, long positions. So let's be careful out there. Do trade with tight stop losses in place and do keep your positions light. Friends, the index segment done. Now I come to the most popular segment of my video, where I give you 5 stocks which are high impetus, high beta. So you take small exposure on them and wait for large price moves. And I'll give you 5 stocks which are low beta, low impetus, where you take big exposure and wait for small price moves. Why the difference? Because different traders, different techniques, different mindsets, and different aptitudes. Therefore, different strategies. So the high beta, where you take a small exposure and wait for large price moves, the high beta list is led by Mahindra & Mahindra at number 1, number 2 Adani Enterprises, number 3 Wipro, number 4 Tata Chem, and number 5 Cummins India. The low beta, low impetus stock list is led by IDFC First Bank at number 1, JK Cements at number 2, LIC Housing at number 3, number 4 being HDFC Bank, and number 5 Eicher Motors. Friends, this hierarchy of high and low beta stocks changes hour to hour, day to day. Do connect with me on social media. My contact coordinates come at the fag end of this video, wherein I update these changes on the social media accounts at the end of the day. So let's connect and let's have conversations going, help each other become better traders. Friends, I now bid goodbye to you, not before reminding you to click like on this video and subscribe to my YouTube channel if you haven't already done so. In the comment section, please do let me know of what you think of my work and help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. Also, in the description segment below this video are hyperlinks to my playlist on Equity Masters YouTube channel. Please do subscribe to that playlist. I post a couple of market views as there as well. And there is a free trading guide on offer from Equity Master in PDF format. Do avail of this offer from Equity Master as well and energize your trading strategies. Friends, I bid goodbye to you and I wish you a very, very profitable week ahead. Thank you for your patience. Thank you for watching my video. Please stay very safe from the Omicron virus. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.